start using them against those other countries. This system is not fair to the United States and never was. And so on April 2nd, I wanted to make it April 1st, but I didn't.
Trump's reciprocal tariff policy is unveiled. The world is heading toward a World War III script. Goldman Sachs has raised the probability of a U.S. economic recession from 20% significantly to 35%. A new storm is brewing, but most people still have no clue. Want to ask a question? What do you all think? Will Trump's super tariffs increase even more? The Trump administration is about to roll out a new round of tariff policies. The price of gold futures per ounce has broken through $3,100, hitting its 16th all-time high this year, with a year-to-date increase of over 20%. The Wall Street Journal reveals that Trump's plan is still being finalized. His team hasn't decided which approach to use to fulfill the promise of reshaping the U.S. economic landscape. But one thing's clear. Trump has shifted to favoring a tougher stance, involving broader coverage and higher tax rates. The only question left is whether to differentiate between trade partners or impose a blanket tariff across the board. So, what exactly are America's super tariffs? What do Trump and the American empire want? And how does all this affect us behind the scenes? Hello everyone, this is Elijah, your finance prophet from Awesome Finance. Please like, share, and support us. Let's dive into today's topic, Trump's super tariffs. It's likely still the U.S. goods trade deficit. Looking at 2024, the bulk of U.S. imports come from 15 economies, accounting for 86% of the total. U.S. exports to these economies make up about 74% of total U.S. exports. Reducing the trade deficit with this group is the primary goal of Trump's tariffs. Why does he focus on these economies? The main reason is, first, these economies represent the largest sources of the U.S. trade deficit. First off, targeting them sends a clearer signal that the U.S. wants to shrink its trade deficit. Trump aims to bring manufacturing back. And second, focusing on key economies helps speed up U.S. negotiations, whether it's tariffs, non-tariff measures, or investments into the U.S. Trump wants results on these issues. For example, at the end of March, Hyundai Motor from South Korea announced at the White House an additional $21 billion investment in the U.S. Trump said this investment clearly shows tariffs are highly effective. Third, narrowing the scope of tariffs also helps U.S. businesses and consumers gain maximum certainty as quickly as possible. What gets tariffed? What gets shifted? But make no mistake, tariffs will disrupt the current U.S. resource allocation. The end result? Higher prices, slower growth, and increased global economic volatility. Among these 15 economies, based on WCO data from 2023, 12 of them have weighted average tariff rates higher than the U.S.'s 2.2%. After adding value-added tax, except for Japan, the tax rates of the other economies all exceed the U.S. Among them, India, the EU, South Africa, Mexico, and South Korea all have rates above 18%. If super tariffs are implemented, these economies will face the biggest shocks, precisely because they've taken the most advantage of the U.S. Considering that after Trump took office, he imposed 2 rounds of tariffs on us, Trump's reciprocal tariffs could end up with 3 possible outcomes. First, the standard version? The U.S. aligns with the most favored nation tariff rates of these 15 economies and adds an extra 1/3 of their value-added tax rate. This would raise the U.S. effective tariff rate from 2.4% by 13.9 percentage points to 16.3%. Second, the moderate version. The U.S. aligns with the 15 economies' most favored nation tariff rates without adding extra value-added tax, making the U.S. effective tariff rate rise to 13.3%. Third, the aggressive version. The U.S. aligns with the 15 economies' most favored nation tariff rates and stacks on 2/3 of their value-added tax, pushing the U.S. effective tariff rate to 20.2%. In this scenario, U.S. tariffs would reach their highest level in 100 years. What would the consequences be? Under the standard version, U.S. inflation would rise by 1.1 percentage points, generating an extra $453 billion in fiscal revenue, but reducing U.S. GDP by 0.8 percentage points. Under the moderate version, it would push U.S. inflation up by 0.9 percentage points, add $353.2 billion in fiscal revenue, and cut U.S. GDP by 0.6 percentage points. In the aggressive version, U.S. inflation would jump by 1.5%. Fiscal revenue would increase by $579.1 billion, and GDP would drop by 1 percentage point. The biggest impact of U.S. tariffs will still be on financial markets. Last week, Indonesia's stock market saw its biggest single-day drop in over a decade, and just 1 day later, The Turkish lira plummeted by more than 10%. All of this follows a pattern. Back in 2013, the big players identified 5 large developing countries particularly sensitive to foreign hot money flows and labeled them the Fragile Five: Indonesia, Turkey, South Africa, India, and Brazil. These nations rely heavily on overseas capital, facing twin deficits in their current accounts and budgets, making them especially vulnerable to dollar-driven shocks, tariffs, financialization, and weaponization. Trump is using them to reshape the entire world. Take the recently invented secondary tariffs, for example. Trump, upset with Putin, threatened to impose secondary tariffs on Russian oil. This is an unprecedented tool crafted by the Trump administration, a new type of economic warfare weapon. And the explicit targets of these secondary tariffs are Venezuela. Any country buying oil or natural gas from Venezuela will have to pay an extra 25% tariff in trade with the U.S. Francisco Monaldi, director of Latin American energy policy at Rice University's Baker Institute, says this is a new concept in economic warfare. But how this policy will be enforced? No one knows yet. But there's no doubt, this is economic warfare. Trump himself has said he's not too keen on financial sanctions, because sanctions could speed up de-dollarization, killing the dollar and everything it stands for. But tariffs? They're negotiable and can boost dollar revenue. They seem a lot more useful than sanctions. Treasury Secretary Besant once hinted that Trump's tariffs serve 3 purposes: gaining leverage in negotiations, generating revenue to offset tax cut costs, and possibly rebalancing U.S. trade. Judging from history, this tariff storm likely won't be decided in a day. Trump will treat it as a long-term weapon, wielding it to threaten the world at every turn. Whoever he doesn't like gets hit with tariffs. The global economy and trade will descend into chaotic turmoil. The most obvious example? U.S. companies no longer know what the future holds, causing these big firms to start slashing budgets and adjusting policies to brace for any wild moves Trump might make. What's the ultimate goal of Trump's super tariffs? A lot of people might not have thought about this, but over the past few years, the world has been following a cycle: the Biden big cycle. Post-pandemic, the Biden administration kicked off massive fiscal stimulus, paired with the AI narrative and U.S. subsidy-driven industrial policies, achieving a period of high growth, high interest rates, and high inflation, fueling a stock market and economic boom. This kept drawing global capital into the U.S., propping up the U.S. even amid massive money printing, creating the bizarre sight of a strengthening dollar. It stretched U.S. stocks and the dollar's valuation to historic highs. But the Biden big cycle has 2 fatal flaws. First, the financial market risks are enormous. Fiscal stimulus doesn't come without a cost. A worsening trade deficit is the biggest hit. When the U.S. stops pumping out money, capital flows out of U.S. stocks, bonds, and the dollar, like we've seen this year. Second, it's widened the wealth gap even further. That's the real reason Biden and the Democrats lost the election. Trump and Besant saw through it clearly. Massive fiscal stimulus hurt the bottom 50% of people, or even more, by eroding their interests. High inflation devoured ordinary people's wealth, with prices soaring to new heights, making life harder for the average person. Stock and real estate gains mostly benefited the top 10% of the rich, but skyrocketing loan rates and a 50%+ surge in living costs, food, clothing, housing, transportation, worsened social inequality and instability. Besant said this is undoubtedly a heavy blow to the American dream. In plain terms, the Biden big cycle let a small group of people rake in more, fattening up financial capital, while ordinary folks and real industrial capital, regular businesses, kept declining, losing competitiveness. A simple example: a popular YouTube video shows an American farmer complaining about Chinese lawnmowers. One costs just 20,000 to 30,000 RMB, while an American mower costs tens of thousands of dollars. The U.S. government wants people to support Made in America, but how can ordinary folks afford to shell out that much? The masses are living in dire straits. This isn't an exaggeration. A friend of mine went to NVIDIA's GTC conference last month, ate for 2 days, and said he couldn't afford it. The price of a meal in dollars is almost the same as in RMB now. Trump took over the Biden big cycle at its peak, but he can't keep it going. The Republicans can't keep it going. So Trump decided on a grand reset, breaking all the old logic and starting over. First move, everyone knows: doggy cutting debt, reducing the deficit rate to 3.5% at the cost of a stock market drop. Second move, deregulation, encouraging the private sector to take on leverage again. Earlier, Trump held a meeting with U.S. tech companies, intimidating and threatening to lure global giants to invest in the U.S. companies. Take on leverage. The government sheds it, keeping the U.S. economy stable. Third move, impose tariffs, restructuring the international trade system. With the tariff stick, he aims to bring manufacturing jobs back to America, reviving the middle class and putting food on people's tables. But a strong dollar, high wages, and high costs are the root reasons U.S. manufacturing struggles to rebound. Simply put, Trump's grand reset is a bit like an American version of moving from virtual to real, making financial capital bleed to pave the way for real capital. But it'll be incredibly tough. Political elites, financial oligarchs, and global giants used to feeding off the people won't protest openly, but they'll throw plenty of obstacles behind the scenes. A simple example, Trump's approval ratings are dropping fast. Next year's midterms will likely cost him one chamber. Will Trump dare touch the sky-high military budget or the even more astronomical debt interest payments? Those are the biggest pies in the pockets of America's shadow government. One assassination attempt wasn't enough. These crazy capitalists might keep trying. There's a famous Ferguson rule. When any major power's interest payments exceed its military spending, it ceases to be a major power. In plain terms, if the U.S. trade deficit shrinks, demand for dollar assets will drop too. Why has the U.S. stock market stood out in the past? Because other countries, after earning money, still had to buy U.S. bonds, stocks, and dollars. But Trump's grand reset breaks all that logic, making the East rises, West falls narrative a real possibility. The U.S. faces the risk of a triple kill in stocks, bonds, and currency. In the stock market, high U.S. valuations could crash back down. Global companies' profits take a hit, killing performance, and a shrinking trade deficit kills buying demand. In the bond market, U.S. hedge funds are the biggest marginal buyers of U.S. bonds, but most are engaged in yield spread arbitrage. Long on Treasury bonds on one hand, short on Treasury futures on the other. Because even these capitals don't believe Trump can keep inflation under control. Once super tariffs hit and inflation spirals out of control, a global liquidity disaster could erupt. On the currency front, the Biden big cycle is gone. Trump wants a trade surplus and a thriving manufacturing sector, so a dollar devaluing Plaza Accord-style deal might be his last card to play. Of course, this isn't the 90s or the Plaza Accord era. His opponents aren't Japan and Germany, nations occupied by U.S. troops. If Trump pushes too hard and messes up, what will we see in the future? Best case scenario. Dollar asset valuations drop, global capital flows out of the U.S., and some stable countries and economies absorb the liquidity, with the U.S. accepting its declining status. Worst-case scenario, U.S. reforms fail to fix internal problems, and in desperation, Trump shifts the blame outward. It's all their fault. Everything's because of them. Throwing tantrums, war breaking out, what does that mean? No need for history to spell it out. It's played out too many times before. Those who get it, get it. Let's wait and see. Your support is the biggest motivation for Elijah's updates. I hope Awesome Finance can keep going until we all retire together. Wishing you all smooth sailing and safe profits. This is Awesome Finance. See you next time.